Big news for the banking industry today as the U.S. House and Senate finally reached a compromise agreement on how to regulate the financial services industry. We've been looking hard at how this is going to affect bank profits all morning long. One person who ought to have a good idea is Bill Winters. He's the former co-CEO of JPMorgan's investment bank and earlier this month was named a member of an independent commission on banking here in the UK that will report to Finance Minister George Osborne. Chancellor of the Exchequer is what they call him over here, but we're just trying to translate for you. Bill, wonderful to have you. It is no understatement that what we're seeing today, the compromise agreement, represents the biggest overhaul in financial services regulation in 70 years.
No doubt.
Is Barney Frank right that this is a stronger bill than maybe what we might have seen yesterday and certainly what we would have seen a week ago?
I guess it's a stronger bill than what we might have seen yesterday and maybe a week ago. It's certainly a strong bill. There's a lot in that. Always a little bit concerning when the sorts of compromises that we've seen overnight happen in a rush. So we can all hope that they've thought through details. But certainly the gist of this is it's substantive. It will make a difference. It will have an impact on the banks for some time to come. And it's at the same time nowhere near as bad as what the banks might have feared as recently as a week ago.
Okay, so let's try to game out the winners and losers here, either by business, by institution. I mean, who got something out of these last-minute negotiations and who lost?
Well, I think as is the case in these sorts of negotiations always, everybody got something and everybody had to give something up. So I think some of the worst case outcomes for banks in terms of derivatives, for example, seem to have been avoided. But nevertheless, the implications of this bill seem to be quite substantive for the banks, particularly for their non-interest rate and currency-related derivative activities. But I think banks had pretty well factored in already the idea that most derivatives would, if not all derivatives, would end up being cleared through a central clearing counterparty. And I think the banks have supported that thrust. So not a huge surprise, and probably not a huge cost either.
How about the compromise reached on the Volcker rule? On the one half, you have this 3% provision, let's call it. No more than 3% of any fund's capital can be supplied by the banks, and they can't invest more than 3% of Tier 1 capital in private equity and hedge funds. And then the ban on prop trading, it's there. There's a stricter definition for it. How negative is this going to impact bank profits?
I don't think it'll have any impact at all on most banks. I think it's a very pragmatic resolution. It's saying the banks can't push the boat out and really risk their firms in these non-core activities to the extent that that's what they've been defined as. And at 3% of Tier 1 capital, that's a reasonable amount to be investing in something that isn't fundamentally banking or client-driven. And by the same token, it allows banks to seed funds or private equity funds where the primary purpose is to distribute an asset management vehicle. So I think it's a pragmatic solution that should result in the banks having no big issues.
How about the conflict of interest guidelines on asset-backed securitizations? A lot of people will applaud that. How about from a bank profitability standpoint?
I'm not sure that there's a huge bank profitability dimension here. I think that the real issue is how are we going to get consumer lending out of the central banks and the GSEs in the U.S. and into the banking sector or the capital markets. And I'm afraid nothing in this bill, at least from what I can see, makes that any more likely or any easier. In fact, I think it will be very hard to get central banks out of the consumer lending business.
Okay, Bill, when we come back after a break, we're going to talk about European banking. But one question I have to ask you with about 30 seconds to go. If the banks were ready for this, if all of these things really aren't going to add up to that much in terms of banking profits, it doesn't sound like it's a particularly strong bill.
Well, I think the punchline was always going to be the banks have to hold more capital than they were holding before. That's already been priced into every bank security price, and I think the conclusion of this U.S. process has been just that. Amongst other things, which are relatively small, the banks will be holding more capital. That makes the system safer and sounder and obviously reduces bank returns.
Bill, let us use this opportunity to talk about European banking. The news of the day is certainly U.S. bank reform, and that is a very big deal, but we covered that. The bank tax here in England, what's going to happen if France and Germany don't follow through with a bank tax of their own?
Look, I think independent of whether France or Germany follow through with the bank tax, every bank is going to be looking pretty hard at the liabilities that they carry in their UK operation to see whether they can't be carried someplace else. And obviously with liabilities go assets. And in some cases it'll be very easy to move those assets to perhaps not France or Germany, perhaps to Switzerland or Hong Kong or Singapore or the United States. So clearly any prudent bank manager has already begun that work, and we can expect to see on the margin a migration of assets and liabilities away from UK banks to more tax-friendly parts of the world.
Well, that raises a very good question. Take that and add to it what George Osborne said when he delivered his budget in Parliament, that he wants to rebalance the economy away from finance. Is that simply an invitation for banks to effectively leave London?
I hope not, because clearly what the UK should be focusing on is building up the rest of their industrial base to complement the very strong position that the UK has in financial services. So I would hope that through the various processes that the UK government is going through, that they recognize one of the core strengths of the UK economy is the export of financial services, and that export business should be maintained. But of course, if along the way they ever feel a need to compromise financial stability, they've made it very clear what the priority is. Financial stability first, and maintaining the industry second.
But has that taken us to a point where UK banks are already, call it, overregulated then?
Not necessarily. I think you're seeing pretty dramatic regulatory changes sweeping through the U.S., the EU, the UK as part of the EU, and take Switzerland as an example of a country that's not beholden to these other political pressures, but nevertheless has imposed what looks like a 16% Tier 1 ratio on their banks.
You talked about the possibility of bank balance sheet assets leaving for Singapore. How much of a threat to Western banking, given the regulatory reform, does Asian banking now represent?
I think on the margin, it's a threat. And in environments like Singapore or Hong Kong that are well-regulated, well-established, good infrastructure, very credible to the external world, for a bank that can do business more cheaply in a location, cheaper from a tax perspective or otherwise, rather than in New York or London or Paris, they'll take that opportunity.
So regulatory arbitrage is a reality?
Regulatory and fiscal arbitrage, I would say. Absolutely.
How long do you think it's going to take before we see a meaningful shift of assets eastward?
I think it will happen slowly and gradually. It requires re-geared infrastructure, and in many cases, there are requirements to book local assets locally. So there's a big chunk of the asset pool that just simply isn't susceptible to being moved. But you'll certainly see more focus on deposits over wholesale money, and clearly that's going to be complemented by higher capital as well, which is the easiest way to avoid this UK bank tax levy.
Let's talk about European banks in general. Should we be concerned right now about the solvency of the European banking industry?
It'd be very interesting to see what the Europeans come out with on their stress test, because the question everybody's asking is, are you going to include scenarios that involve the restructuring of Greek or another country's debt in these stress tests? Because if the answer is, if you do include it, we already know the answer, there are real issues. If you don't include it, we're not sure that we're going to take that test very seriously. So navigating through that binary minefield is going to be a real challenge for the policymakers.
How do you think the investment community will respond either way? Without sovereign restructuring, what happens to these banks? With, as you pointed out, sovereign restructuring, it's going to look really ugly.
I think the market has spoken, the market refreshes its speech every day, but the market is saying that there's a reasonable likelihood that the stakeholders are going to have to take a hit to get Greece onto a sustainable debt level, and that will require, in some cases, recapitalization of some banks, and they just like the answers to that. If it turns out that the EU Commission really has just got it right, and that it's all going to work out, well, that'll be super. But it's going to take quite a while before the market believes that.
Bill, speaking of recapitalization, how is it that these banks are going to recapitalize when the prospects for delivering ROE, return on equity, or return on assets continues to diminish?
Well, we know how the U.S. banks were recapitalized. It was called TARP, and it was a quick injection of capital from the U.S. government, some of which, in retrospect, it turned out wasn't necessary, some of which it turned out, in retrospect, was necessary. But clearly the imperative of the day was capital in, and we'll worry about the details later. Now, the Europeans have much more time to think through any recapitalization that's required, but to the extent that it is required, I'm afraid it's going to have to go the same route.
All right, Bill, one yes or no answer. Do the Basel III rules need to be delayed or watered down, yes or no?
Well, they will be delayed. They will be watered down. They shouldn't be either.